Hello, everyone, and welcome to our K-1 and Pass-Through Entity series. I'm Dave Stauffacher, the Senior Credit Trainer with Lenders Online Training, where we help lending and credit professionals say yes to good loans. Linda Keith, our company's founder and Chief Credit Training Officer, is here joining me today. Hi, Linda.
Hello, hello.
You know, Linda, we've had all kinds of questions throughout the months when we've started this series, and here's another question I think probably has some strong relevance because I know it comes into my training sessions with our learners. It's regarding passive versus non-passive on that Schedule E, and what are they defined, and do they actually make a difference in our analysis? Now, as I mentioned before, in our training, I come across this a lot where the IRS has a uniqueness way of, in the terms that they use that often are unclear to us as lenders and probably the general public in general. So we think of non-passive fits the bill. It's kind of a double negative. And I know when I was writing, double negatives don't make sense. So let's start with that one first. Non-passive translates more to the term as active. And that's what I tell our lenders that come to our classes. Just cross out non-passive and put active. So on the non-passive side, if I was the owner, most likely I'm active in the business. I'm managing the business. I'm making decisions. So in that case, there'd be no limits to the passive losses, which I would explain in a moment when you talk about the passive losses area. So when we talk about non-passive as also known active, it's very likely that they're probably control the checkbook. They're the higher percentage owners. They make most of the decisions. They probably have guaranteed debt. They've been inclined to come to the table, and they probably had to bring money to the table. So they have kind of full control, and most likely they should get access to whether it's the offset of losses in general, but they are most likely the ones that we are considering about. We also believe that the high percentage owner, the share of the business, is probably more indicative of the cash flow of the company. As I mentioned before, they own the checkbook. They're making the decisions, sometimes where salary may go or what type of decisions. So if we're making any guidelines, at least from the K-1 perspective, every non-passive entity that we deal with, probably if it's not obligated to the loan, we'd want to make sure that we've at least looked at the full entity return. And honestly, for me, I look at the full entity return whenever I can get that. I think in general, I think it adds some value to understanding the relationship in general that we need to understand. Does that make sense, Linda?
Yeah, it does. And one of the things that I think is important to realize is that as we're looking at a 1040 and seeing the list, so we're talking about 1040 Schedule E, passive on one side, non-passive on the other. If we are doing a global analysis, one of those entities may be the one we're lending to, in which case we really are getting the full return. But there might be other entities in there. They're not obligated on the loan. We're not lending to them, but they're in the non-passive side. And that's where I think the realization that if they're over there, they are active, they probably are guaranteeing debt, means that, like you, David, I kind of want to see those entity returns, even if they're not obligated. Because if they're over there, I think my borrower is more likely to have guaranteed debt and be running this business. And frankly, if I was a business owner, and let's say I had 3 businesses and 2 are doing really well and one is just really struggling, I wouldn't come to the lender with the struggling one, right? I would come in with the good one and try to borrow money from that. And then as a high percentage owner, be able to kind of rob Peter to pay Paul. So that's why David and I kind of say, listen, if it's on the non-passive side, in general, I'm quite interested in the details of what that is. But that's the non-passive. And yes, non-passive makes no sense. Just change it to active in your head. And so that does bring us, David, to that other one, which is the passive side.
Yes. What about passive?
Well, you kind of got the fun one. Mine isn't quite so fun, but passive really does mean what it sounds. The owner is not active in the business. Now, here's why it makes a difference. Prior to 1984, rich people could write off their passive paper losses, if you will, against real money that they had coming in. So it didn't seem fair. It was like, geez, these rich people, they got paper losses, they get rid of a bunch of taxes, and those of us who are working hard for a living, have to pay taxes on everything. So in 1984, this was actually Ronald Reagan in his proposal for simplicity, fairness, and growth. I remember this because it turns out that while he might have gotten fairness and growth right, he definitely didn't get simplicity. He didn't get that one right at all. Cracks me up what we name these bills. But anyway, the idea was they set up this passive category to say you no longer can take passive losses against non-passive income. You can't do the paper loss thing. So what's funny was at the time, I was in tax practice at the time, we called passive activity losses PALs because they were so beneficial to our more wealthy our taxpayers. And so as soon as they changed the rules, we were looking for pigs. The pigs were the passive income generators, which now could sop up those losses that we had thought we'd get to use and weren't going to get to use because there was now a limit. Now, the bankers don't need to know any of that, actually, but sometimes I think that the background kind of helps you understand. Passive is then not active in the business. It will not be over there if I'm a decision maker in the business. So in class, we have them cross off the word passive and write investor. A little more like an investor, not an active owner. And an active owner can't be over there. So if it's in the non-passive side, it's either an S Corp shareholder. It could be a general partner, because general partners may or may not be active in the business, but it couldn't be a limited partner because to be a limited partner, the rule is you can't be active in the business, right? Limited partners, by the way, also don't want to guarantee anything. The whole point about being a limited partner is I'm an investor, but I'm not on the hook if things go wrong, right? So for us, if it's on the passive side, more like investors, if they have 38 K-1s over there and somebody said, Linda, do I really have to look at all 38? I'd be more inclined to give you a pass on something over on the passive side. I would never give you a pass if it's on the non-passive side. I really want to see it. So that really is the difference between the two. I might point out that if you have a general partner who is reporting on the passive side, that's a huge red flag for me. General partners, by definition, have unlimited liability. If they're not actively involved in the business, what the heck? What the heck? You see this sometimes in family partnerships, the kind of legacy ones where they were a general partner, a limited partner at one point, never have gone to an LLC or an S Corp or something that provides more protection to the elders who are running the business but now leaving, especially in ag. You'll see family farms, right? Well, the folks in the family farm that finally have net worth, the elders, as they move out of position of decision making, but they're still in a general partnership. I think we just went off the passive versus non-passive topic, but general partners, riskiest thing we've got. A general partner that is on the passive side is the riskiest situation I can even think of. All right. So we do have, by the way, one of our modules is on types of entities, and I'm gonna make an offer to those of you listening to this live stream. And by the way, this isn't written anywhere, so you're just gonna have to send us at experts@lendersonlinetraining. Say Linda said, but if you send us an email and you ask us for the link to the types of entities module, it's inside our Lenders Online Training. But I've just made a decision as founder of the company that I will send it to you. So you just have to say, Linda said, we would like the types of entities link, and we will get that out to you because it does a really good job of explaining the different entities and the risk of the owners in those different entities. All right, so looking at my list, and sure enough, we're talking longer than we planned, but what the heck. So David, now I'm going to ask you if the side makes a difference for the tax treatment of the taxable income or loss. So we talked about what it means for whether they're active in the business or not, but are there what are these limitations I was mentioning?
With regards to the K-1 and the full as far as the choice, does it make sense from a K-1 or a full entity return? From that perspective, we've always said, or at least I've always believed in, it depends. It kind of depends on our guidelines of the financial institution that we're working for and who we're lending to.
Yeah.
Most of the times in my classes, when I'm basically conversing with lenders, we look at the guidelines as kind of a point of reference. Now, for our perspective, we use 25% kind of as a benchmark. If the owner is less than 25% owner on the K-1, that cash flow, probably he does not have the control of the checkbook normally and generally. So I generally will just not ask for the tax return. No, I know I mentioned in prior live cats that I do like to see the tax returns of the entities because there's more information there that I'd like to have access to. But if you've got a minority party in this, it may be uncomfortable for the other parties to say, what does the bank need to know that information for? So I'll just kind of go to a high level overview. But if it is over 25%, I'm going to ask access for that tax return of all the ones that, because they're basically having some say-so into it, and I want to know more about the cash flows of the entity. I want to know what's going on there as far as the debt service, what type of distributions, etc. So high percentage ownerships, I think it's a reasonable assumption. Now, let's say I'm not doing the global cash flow and I'm just lending to the entity as well. I'm going to ask for the tax returns. I want to understand that, and I'm going to do a full analysis of that. It's a common approach that many of us do as lenders. We deal with the entity. We want to do the full analysis. It's when we get into the personal analysis, that's when we get into this, what this 25% rule is. Do we get access to that or not for a global analysis? Let's see. So I guess the variation of the K-1, if we use kind of a high level, we're talking about what type of monies they receive through guaranteed payments. If you're dealing with the partnerships, if you're dealing with a K-1, there's some wages in there. There's distributions that we want to be aware of. Percentage of that, we will know that on the K-1. So we can do a very overview analysis of where the cash is coming from the entity through that for the K-1 analysis that would give us a good overview of how it contributes to them personally. Anything else, Linda?
Yeah, it's interesting. We sort of went from passive to non-passive and straight a little bit, which we do all the time because these are so interconnected. But so to just recap, if it's on the passive side, they're not active in the business. That is where I would be more comfortable with just the K-1s, especially under 25%. If it's on the passive side, we still tend to run into that under 25%, just get the K-1s. But as David pointed out, if we can get the full return when we know they're active in the business, they've probably guaranteed debt, then even if we're focused on just their personal analysis for consumer or mortgage loan, I would like to know that the company can afford what they're taking. And I'm going to give you one more variation, which isn't wouldn't be my guidelines, might be your guidelines. We've had banks that we work with who have said, if it's on the non-passive side, but that entity is not obligated on our loan, we will never get their entity return and we'll just get the K-1 no matter percentage ownership. I think you're missing something with that. I'm a little nervous about that. That would not be my guideline, but it could be yours. And your bank, your organization gets to set your guidelines. I would simply encourage you that are setting the guidelines to understand what is the risk with a non-passive entity, even though I'm focused either on the owner or something else that they're guaranteeing. What's the risk that what the K-1 is showing me that they're actually taking is not supported by the entity? And you cannot tell that by the dollar amount on the back of it. We have a live stream on what the 1040 schedule is actually telling us. You cannot tell by the number there because the number that's there is the share of taxable income. There could be tons of depreciation and there's really more, significantly more distributions available, but it could be the reverse. That business could have tons of debt and that the actual amount available out to an owner is significantly less than the taxable income. So the dollar amount you're seeing doesn't tell you anything. So my encouragement to those of you setting guidelines is always ask yourself, if we stick with this firm, hard and fast rule, that if it's non-passive but not obligated, we just get the K-1, what is our risk? And if you're happy with that risk, it's fine. Just be sure you've considered the risk of skipping the full entity return when you know, because it's on the non-passive side, that they are actively engaged in the management and decision-making of that company. I kind of think that was what we had planned to talk about. So that's the passive versus non-passive. We do have 3 modules in our training on 1065s. We have 3 modules in our training on 1120S. We talk about passive versus non-passive when we talk about then 1040. So we definitely do bring it into the training in all the places it needs to be in. Today, we just want to be sure you understand the difference, why it's that way, and what difference it makes to you. If you have any questions at all, texture analysis, financial statement analysis, send it to experts at lendersonlinetraining.com. We answer those questions. We also consider those questions as our live stream topics. And we have our Ask the Experts series. It is a subscription based. It is no charge at all. It comes out once a week, and it is a question we have been asked. Subject line has the question. So you look at the subject line and go, ooh, I do need to follow through on that one, or I don't need that one and nobody else in my group does, in which case you just delete it. But we call that the drip method of learning. Even if you have a good foundation, which is what we focus on in our training, even if you have a really good foundation, what are you doing to get additional knowledge in this area? Because pretty much you probably don't need to stop until you retire, right, David?
Right. Hey, Linda, remember your offer before someone needs to put in there.
Good point. I already forgot. My offer is in experts at lendersonlinetraining.com. You say, Linda said, that's important wording because otherwise they'll go, no, we don't do that. Linda said I could request the types of entities module link. I'm interested. We don't even take your email for that. We're not doing any gatekeeping, anything. I'm simply saying, I think it will help you. You are welcome to get it. That's it for today. Thanks, everybody.